Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for May 25th, 2013. We have a market that is in bullish normal conditions. Using weekly RSI 14, we're overbought at 73 out of 100 in the green. Using 10-day NDX for shorter term, we're in the middle of neutral at 40 out of 100. Looking at the market mosaic additional indicators, percent stretch relative to the 200-day moving average is at 11.91%. We're green bullish. The slope of the 50-day moving average is white bullish at 0.65, so not quite as strong. ADX 14 showing a strongly trending bull market at 34.8. ATR percentage of 0.92 is right at the 6-month average. The risk index, which is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX, has an index value of 1.02, or risk on, meaning that we want exposure to risk assets. The z-score of that 1.02 reading is 0.22 when compared to the last 5,000 days, with normal being between 1 and -1 standard deviations. And you can see the time series of the last 90 days, showing the oscillating nature of that risk index. And we're still in the risk on posture, but not by much because of the pullback in the last few days. The blended monthly rebalancing current holdings continue to be Japan, real estate, and Australia for both the 26 and the 13 ETF portfolio. Next reevaluation on or about 1 June. On 1 June, I'm going to expand the scope of the larger ETF portfolio to include the balance of the sector spiders to give us a chance to get more exposure to U.S. large caps at times like these when they're dominating. So that'll move up to 32 ETFs. In the ETF2 weekly model, the theoretical exposure is at 70%. The model portfolio itself will be at 100% exposed with a couple stops that need to be updated. Trades of the week can be found at that YouTube channel. Quick look at the blended monthly rebalancing portfolio current readings. It's Japan, U.S. real estate, and the U.S. large caps in the 13. And in 26, it's Japan, financials, and Dow real estate. The cash positions are generally in the commodities and international ETFs. Market health check. Vertical blue lines are 10, 20, and 30 days worth of look-back period. Horizontal purple line is the swing high at about 168. The horizontal red lines are support levels that used to be resistance levels in previous moves up. Dark shaded blue area is the 30-period Bollinger Band, plus or minus 1 standard deviation, or known as the river. The lighter blue shaded area is plus or minus 2 standard deviations of that 30-period Bollinger Band. Think of that as the floodplain. You'll notice that price during this strong bullish move was hugging the upper limit of the floodplain and is now pulled back to the edge of the river where we would normally expect it to find support if the bull move were to continue. The thick black line is the 30-period regression line lagged for 1 day. The outer black lines are the RAF regression channel formed by the maximum excursion from the regression line during the look-back period, which happened on last Thursday. And that defines the channel of normal. And then we evaluate the current day's reading against that to see if there's something in the price action that indicates that the normal channel has been violated. We came close, but not quite on Friday. This thin red line is the midpoint of the river, or the 30-period simple moving average. Thin blue is 50. The 200 period is off the chart right now. This thin wavy black line here is the slope of the 30-period regression line adjusted for each day, and you can see that right now this upward sloping regression line is as strong as it's been in the past 4 months by far. So this is a really powerful bullish move in the context of the last 4 months. The y-axis on this side shows the actual slope value, and price is shown over here. We're just coming out of an extended period of overbought. Looking at Williams percent R, it's now back in the lower range of normal. And the percent price oscillator, which works just like a MACD histogram, but on percent moves rather than price, just finished closing a closing signal here on Wednesday, which marks the potential of the end of this run and the beginning of a pullback retracement. Is how we interpret that. And at the top, you can see the trendiness using ADX and default settings, with bull still in charge, but rolled over at about 37 and has come back to about 35. So this nice strong move from about below 15 to above 35 coincided with at the end of a period of chop, followed by a bullish move where it went from below 15 to plus 35. That's what a really powerful trend on the dailies looks like. So my interpretation of all this is a runaway bull, normal volatility, has had an extreme 30-day move. It's pulled back to the edge of the river. This is a natural place for it to find support if we're going to see another leg up. If we do, this would be the logical place for it to find support and go. Otherwise, we'd be looking for it to find support at any of these red lines as downside targets. It's not till price were to fall out of the river at about 157 that we could definitively say that this move is no longer valid. So I expect one or two of the, actually a violation of 162 would be a real warning, because now it would be below the Bollinger Band mean, and that would put this whole move at risk. But right now we're playing this as a opportunity to buy strength on a pullback, and with the next target being back up to a retest of 169. It's got to close above 168 to really give us any indication that this is that there's another leg potential here. So the nearest neighbor of this pullback from 169 to 164 looks like this pullback, which happened during Boston reaction to Boston. And it went from 159 to 154, found support, and then made another leg up. So that's the potential of this move. The previous one where it pulled back that far was this move at the end of February, which prompted another nice rebound. So we will treat that as the likely case, although we're going to respect the downside targets as well. The ETF regional report looks at the top 10 regions of the world market model using the ETF2 discipline. To look at the relative strength consistency, which is the 10-week moving average of strength, and then the quality score, which was a form of system quality number looking at the last 40 weeks. And then the average is the arithmetic average of those three numbers that are scaled 0 to 100. And we're looking at 1,500 different ETFs in the world market model to make that conclusion, along with the 30 Dow industrials. 7 of the 10 regions are on buy signals, looking at their moving average filter. So 7 out of 10 gives us a theoretical model exposure of 70% and 30% cash. We've got the S&P better than EFA, the global, so 59 is better than 54. And so we're favoring the U.S. over the internationals. Inside the U.S., the order of strength is large caps at 59, small caps at 59, then mid caps at 58, and the technology at 58, with tiebreakers being average score, consistency, and quality in this case. And so really we're seeing a convergence of strength now inside the U.S. indexes. That's evidence of broad-based strength in the U.S. at the expense of the internationals and globals. I've added for this report and going forward the S&P Spider extract of that database as well, and showed it against S&P for comparison. And you'll notice that the three strongest sectors have been finance, healthcare, and discretionary by a large margin, with healthcare being dominant across all the time periods. Consumer discretionary and financials are coming on strong, though, you'll notice, because they are green in strength but white in consistency. And so when the strength column is green, that means the current relative strength, using a blend of the 3 and 6 month look back, is very strong and is pulling away from its 10-week moving average. So that's a sign of emerging strength or emerging leadership. Technology is the laggard. Same discipline now, looking at the world market model. I look at the U.S. first. All are above average. All of Europe is above average. Japan is exceptionally strong in the green. Asia, less Japan, weak in the yellow. Asian countries that are above average: China, Malaysia, Thailand, Philippines, Indonesia, Vietnam, South Korea lagging dramatically. All of Latin American emerging markets and the countries lagging. Only Austria and Spain are following behind in Europe. If we look at the business sectors, the U.S. sector spiders versus the global counterparts, in every case, the U.S. is either tied or leading their global counterparts, and there's broad-based world support for healthcare and discretion, consumer discretionary, and then U.S. finance. In the other asset classes, commodities, gold and silver are getting crushed relatively. U.S. real estate and private equity are above average. Treasuries, bonds, oil below average. Looking at the top 30 ETFs from among the 1,500 in the database, it's the little change from last week, except for some of these new emerging leaders like clean energy, Turkey, S&P biotech, home construction and natural gas, the Alpha Dex consumer discretionaries, banks, consumer discretionary spider and financial spiders. That's consistent with the sector spider extract we just saw. So little change week over week among who the leaders are. When we look at the Dow using the same logic, again ranked by strength, you see just how strong Hewlett-Packard is compared really to 1,500 different ETFs in the world. It's the number one over the last 10 weeks of any ownable. It's rebounded all the way back up to 24.21. So emerging strength, Intel, Cisco, JP Morgan. That's actually a rebound in JP Morgan, which used to hold the number one position, fell down all the way into white, and has now begun to recover based on that financial sector strength. It's a leader in that area. United Health rounds out our emerging leaders. The two weakest, Caterpillar and CAT, are still in the yellow, which is pretty good for the Dow and a statement of strength in the U.S. Excuse me. And the two weakest stocks in the Dow are still only slightly below average compared to the rest of the world's choices. So that's a sign of strength in the U.S. Pardon me. Okay, we're going to shift to the daily report now. Just want to highlight that the Euro-Asia blend, Asia less Japan, and emerging markets are both overreaction and channeling system signals. I want you to notice here in the gap stat over the last 30 days that 17 times, 2 plus 15, 17 times out of the last 30, the market has gapped up. Only 2 of those times has the gap up reversed to close lower. When it did, it had an average follow through of minus 0.82. The 15 out of 17 times it's gapped up, it has closed higher still with an almost 0.4% additional follow through. That's the clear pattern right now. This pattern on the gap downs just about a wash right now. You see the S&P volatility has oscillated right back to the 6-month average, so that's why it's bull normal. And the ADX, you can see, has rolled over with bull still firmly in charge. Lots of pattern trades and channeling and overreaction for both ETFs and the Dow 30 large caps. Some 5DD patterns in Asia less Japan, emerging markets, and technology. 551Ws, a rich list to choose from in both ETFs and the Dow 30. Intel is a triple screen. These all test out better than 2-to-1 in the auto framer. Japan, real estate, Walmart, Disney, small caps, financials, utilities, the S&P itself, and AT&T. Looking at the Dow 30 tactical summary, quite a few to choose from here in the auto framer, a handful of dojis. Caterpillar is worth looking at. It's a doji, it's a max pain range compression, tests out at 2.2-to-1 on the auto framer, and has an RSI2 value of 5, meaning it's kind of washed out over the last 2 days, offering an opportunity for value entries. McDonald's is an 8 on the RSI2 and a channeling. And United Tech is a 9 on RSI2, tests out a 2.5 to 1 on the auto framer and is a 551W. So lots of things to choose from here. You can see the strength in Procter & Gamble. Now, interestingly, Hewlett-Packard pulled back to 2421 on Friday. One of the few big losers in the Dow. It's the only one that was an outlier in terms of sell-off at minus 2.6%, but you can see the percent that it's returned over the previous look-back periods. So there may be an opportunity here in Hewlett-Packard, but again, don't buy it blindly. This one may have just, that may have been like a Morningstar Doji kind of a deal, but still well above its averages and very, very strong individual holding. Looking at the ETF 30, tons to choose from, too many to even list, but you can see just how broad-based this 551W pattern is. Lots of channeling and overreactions, lots of 5DDs. Look at this in Asia less Japan. An RSI2 value of 2, a big loser on Friday, 8 to 1 on the reward to risk in the auto framer, number 1 on MPRC, and a max pain, a 5-day down, channeling and overreaction. So a lot to commend it. And XLP, for those of you inclined to reward, it has no patterns, but it was a clear leader that was the big winner on Friday. Financials are looking pretty awesome too. 551W and a 2.1, and you can see how it's outperformed over all the look back periods from 1 day out to 6 months. So that would be an easy one to reward, and you may want to keep JP Morgan in mind. Last chart to look at, the market mosaics. Again, the 30-period regression line. You see how just uniformly up that has been until Wednesday last week with one sell-off. But 2 days of failure to fail further that had buying pressure. Going into the long weekend, I take that as a positive sign. And so although the regression line has started to roll over, it hasn't crossed its 10-period moving average yet. If it were to do so, at a distance of more than 1 standard deviation from the 6-month average, we would take that as a sign of a potential early warning for an intermediate high. And as you can see, that's been a considerably good move here of about 6%. And it also topped out at 2 standard deviations above the 200-day moving average, that stretch that we talk about quite a bit. So this is right now still just a normal pullback. And you can see the last time that it pulled back like that, it then had another 6% move up. So the potential for continuation here is still good. If we take this intermediate period here, this period of chop, based on percent stretch and the regression line slope, it stayed positive, but it really went sideways for about 30 days and then gave us a nice move up. So there's room for it to continue to go. Okay, so that's the news from Kansas on Memorial Day weekend. Be safe, keep your powder dry, and risk measured.